Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Thursday, November 3rd, and then see how things look for the highlights for Friday, November 4th. And this will be the only video posted today. I could have gone through and done a full-length video, but pretty much with the down day that we saw, everything has just shifted to more of a full-blown negative rather than kind of a mixed picture. And with the employment situation report coming out, that's pretty much a roll of the dice as to how the market's going to react to that. If there's pretty much any hint of strength in that report, which has kind of been the general trend, then the markets are just going to tank. And it seems like the Fed has just declared war on the stock market going up. At least I'm hearing a few people say that. And it's like any hint of growth, any hint of inflation, any hint of the economy getting stronger, and the Fed just declares war on that and just insists on raising interest rates. So it's pretty frustrating because earlier this week and at the end of last week, we saw what could have been a pretty positive setup. Things were coming together. The market felt like it knew what was going on, and it may not always like what's going on, but uncertainty is more difficult to deal with than certainty. And that gave a lot of market participants something to focus on. And we ended up trying to take things higher. Well, all of that changed on Wednesday when the press conference basically just said, no, we're not going to really consider slowing the pace. And in fact, things might even stay that way for quite a while. So you've got a lot of really frustrated folks right now who felt that they really understood what was happening. They started to implement their strategies based on that, only to be snuffed out again for what, the fifth or sixth time now in 2022. So let's go back and just talk about what happened. At the open, we gapped lower. We gapped down to S1 at 37.14, but then we rebounded slightly off of that, and then we just kind of danced sideways. Anytime we did try to go a little bit higher, it seemed like 37.50 acted as resistance. That's a nice round number. There's strike prices there. So you had selling come in anytime we got back up to that point. We closed slightly above S1. We were down 1.06% on above average volume. And the technicals, they're pretty much more negative now. We saw more of a mix after Wednesday's session, but then with the decline in Thursday's session, yeah, things have pretty much shifted. And it's because of inflation and interest rates. Any strength is just seen as the enemy, it seems like right now. We still have the geopolitical concerns, and earnings are coming out. We've got any more Fed speak that may make its way out. The midterm election is coming up next week, and we still have the potential situation between Iran and Saudi Arabia, which of course could escalate and erupt, or it may be able to calm down. All right, so here's the intraday chart where here's Wednesday's action where we gyrated all over and then just started to tank. Thursday, we did gap lower down below S1, bounced up a little bit, kind of trailed along this moving average that I plot on the intraday chart. But you can see right here, this is the 37.50 level that acted as resistance. And we ended up closing down just a little bit above S1. All right, so what are some comments that we can make? 3,700 is still providing support. We haven't broke through that level, at least yet. And the long-term support, mainly I'm talking about the weekly chart with the moving average of the 200-week moving average, we're still above that. So that support is still holding up currently. And then also, I saw something that said China may not be reducing their COVID restrictions after all. So there's just so many contradictory things flying around these days. And the VIX, this is really strange. We had a down day. We were down over 1%. The VIX went down. Okay, it just doesn't make any sense. There's other charts that I'm watching that measure this weirdness, but they're not really moving all that much right now. But to have a down day and to see the VIX decline at the same time is quite strange. And so we still continue to be oversold with that RSI 9-period indicator that I plot on there. The pivots, support levels, and moving averages, we're losing those. Pivot levels that were holding up, well, we dropped below them. There's still a few that, especially with the small caps and the mid caps, that are holding up a little bit better. But within the S&P support, we are losing a lot of that, and we're back down to the 20-period moving averages on the S&P 500. We blew through the 50. The Dow blew through its 200. So it just, things are just pretty negative at the current time, which again, on a contrarian basis, sometimes it's like, okay, when everything's looking really bad, that's sometimes when things turn for good. But the employment situation report is the big deal. And so we're just going to have to wait and see what that says and then how the market reacts to it. And that's why I decided not to do a full-length video for today. But our oscillators, they're still positive, even though they're rolling over another day or so of this. And at least our shorter term ones, they're going to start to turn negative, but they're still positive. And then this is kind of a big deal too. The parabolic SAR, the one with the dots either above or below, it just turned back to negative. There's a dot on top right now. Interest rates still continue to go up, and we still have a number of yield curves that are inverted. Sentiment has switched back to neutral. We actually ticked up a little bit. This is kind of strange. But to have a down day be down more than 1% and have sentiment tick up, show a little bit of improvement, that's kind of strange. The reports that came out, jobless claims, a little bit less than expected. And this is the culprit right now that seems to be holding things up. It's like, okay, the economy might be falling apart, but the employment is still hanging in there. And then the trade balance, it was down 73.3 billion, a little bit more than was expected. The last time we had this report, we were down 65.7 billion. Not a huge influence, but just to kind of show you the overall condition of the economy. We also had the preliminary reading for productivity. It came in at 0.3, which was weaker than the 0.5 they had expected. Last time it was down 4.1%. So they're looking at that actually picking up a little bit overall. And then the labor costs, the preliminary was 3.5%, weaker than expected. And they expected it to be in at 4.2%. The last time we got this, it was at 8.9%. So that is coming down too. So it's costing companies a little bit less to produce products based on the labor that is needed. We had the IHS Market Services PMI. The final reading was at 47.8 or below 50. So that is showing a contraction in the economy. Factory orders came in as expected at up 0.3%. And the big one was the non-manufacturing index for ISM. It came in at 54.4, weaker than expected at 55.2. And then the last time we had a reading of 56.7. So weaker than expected and also declining, but still above 50. Our trend is negative. It's just slightly, like 20.16 or something. So we're just barely above 20 right now, but it is weakening. We're below the moving average. The red line is on top. Our bias is negative, and I've switched our momentum back to negative. There's been a real shift. The whole Fed press conference really took the wind out of the sails of the market. Now, that could change at any time, and the markets are constantly moving back and forth between euphoria and suicide. But for right now, things are pretty down. All right, here's the daily chart showing how we've been dropping through support. We fell below the 50-period moving average. We came right down to the pivot level. Maybe we could have found some support off that. No, we gapped lower and have actually dropped below the pivot. So things have switched more on a bigger picture. The monthly pivot points were now more negative. All right, then just to update you, the World Series just ended a little bit before I started recording this, and Philadelphia now leads 3-2. I'm not putting any importance on this at all. It's just a coincidental thing that anytime, and I don't know why, in yesterday's video I said St. Louis. My gosh, they're not in the World Series. It should be Philadelphia. But whenever Philadelphia has won, 1929, 1930, 1980, 2008, we've typically have had pretty difficult economic times. We'll see. I don't know. Now they're down 3-2. So what's our outlook then for Friday? We're negative pretty much across the board. We have the employment situation report coming out, and that's going to be the biggie, and that's the pretty much the only report that I could find that's being released. But there's a lot of things inside that report. The whole geopolitical events, but right now the markets really are mostly fixated on inflation and interest rates. And then if we get any Fed speak, but always be prepared. Some of these other things that are listed here, they could escalate and come to the forefront and then eventually be picked up by the markets and have some influence there, but they don't seem to be doing that, at least yet. So our scenarios, we have to go with the down scenario. Yesterday's video, I kind of was split between the two because we were at support. We kind of overdid it in Wednesday's session. It looks like maybe we could have got a bounce out of that. But then when we gapped lower in Thursday's session, that wiped all that off. And then we ended up not really bouncing from those levels. So we have to go with the down scenario because the technicals are more decidedly negative. I've taken off the up scenario for right now. As I've been saying, we're losing moving averages, pivot points. We still have some fib retracements, but we've lost some of those as well. And then we're still just slightly above 20 with the ADX, so we can't really go with the neutral scenario. So what's our conclusion? S&P is negative. Short-term negative, intermediate-term negative, and long-term negative, and still below the 200-day simple moving average. So thank you. I will prepare a full-length video over the weekend for Monday's session, as well as the weekly video update and the intermarket analysis. So have a great Friday, and I'll talk to you in the next video.